Hello and welcome to the lecture for Chapter 9. As you can see, this chapter deals with liabilities. We'll start out by talking about current liabilities, how they're defined, what some examples of them are. I'll talk briefly about the AP turnover ratio and how that's used. We'll talk about longer-term payables like notes payable, longer-term liabilities, and the time value of money. Talk about contingent liabilities, working capital, and then long-term liabilities and present values. So current liabilities, just as a reminder, are any liability that is going to be satisfied with current assets and be paid within the upcoming 12-month window. So you can see here for this company, for Starbucks, their current liabilities are accounts payable, accrued liabilities, so accrued payroll and benefits. So those two accruals are things that are triggered by journal entries, not transactions. Income taxes payable, the current portion of long-term operating leases, and then they've got other short-term debt. So again, it's important for readers of financial statements to see this figure and see the total, because that's going to be a drain on cash in the upcoming 12 months. So we'll compare that to current assets. So the textbook had a very good definition of liabilities, because oftentimes we think about it just in terms of, debt we owe to a bank or that sort of thing. So they define a liability as the probable future sacrifice of economic benefits that arise from past transactions. So it's kind of more broad than just what is going to be paid with cash. It could be satisfied other ways. The amount that we'll recognize for that liability is the amount that that debtor, or that creditor rather, would accept in cash immediately to settle the debt. So if the debt is due in 5 years, well, what would that creditor take today to settle the debt? That's the way we would want to value it. The difference between what it would take to settle the debt today and what we're eventually going to settle it for, well, that difference is interest. So different kinds of operating activities are affiliated with different kinds of current liabilities. So the purchase of inventory, the purchase of supplies, those kinds of things would trigger accounts payable. That's usually one of the larger categories of current liabilities. Renting space for stores, as an example, on a lease, that would be the current portion of an operating lease liability. The way leases are accounted for changed in the last several years. It used to be that it was just essentially treated as rent. You just expensed it as you paid it. The problem is, if one company signed a 1-year lease and another company signed a 10-year lease, you couldn't really determine the difference between those two companies on their balance sheet. So now we record an asset called the right to use, and we record a liability, operating lease liability. So we now have a current liability for the current portion of those rental payments. Employees, that would be accrued payroll and benefits. So once they've worked for us, we owe them that money if payday hasn't come yet. And then, of course, customers that pay in advance. So money that we receive in advance of earning it is going to be an unearned revenue kind of liability. So this is the math here for doing an accounts payable turnover. Basically, it's looking how frequently are you paying your payables. So if you had a figure of 12, then you're paying them once a month. You're paying bills as they hit 30 days. It's kind of interesting. I've worked in companies before where the accounting team is kind of patted on the back or complimented if they have a low number here, if they're dragging their feet to pay accounts payable as long as they possibly can, because it means the company is keeping its cash in the bank or limiting how much it borrows to be able to pay its suppliers. So it's considered good cash management practices to wait as long as you can before you pay people. I think that's a little bit short-sighted in the sense that most companies rely on their suppliers in order to satisfy their own customers. And suppliers that you're intentionally paying late because you're trying to optimize your cash management are not going to enjoy doing business with you. So that's been my personal experience. So accrued liabilities, some examples: accrued income tax payable, accrued compensation, meaning payroll and the benefits associated with it, accrued payroll taxes, and the deferred revenues. Those are all expenses that have been incurred before the end of an accounting period, but we haven't received an invoice or we haven't got a paycheck. Something has not happened, some transactions not happened that would trigger an entry in the accounting system. So these liabilities wouldn't be represented on our balance sheet if we didn't make an accrual entry. So they have to be, I always think of accrual connected to the word add. We have to add it to our books. So accrued compensation and benefits, of course, if say the pay period ends on the 25th and you're doing financial statements on the 31st and the payday is on the 1st of the following month, then you're going to need to accrue wages for that intervening 5 days in that example. Where most companies trip up a little bit, it deals with fringe benefits. So vacation, generally employees earn vacation as they work. So if you work at a job and you get 6 vacation days your first year, well, you're earning a half a day every month. And so the proper way to account for that is to record the expense associated with that vacation in the month in which it's earned, and you record a liability. And then when somebody actually takes their vacation, you're just paying the liability. You're not recognizing an expense at that point, which these entries here reflect. So a little bit about payroll. That's the amount that we pay to employees for their services, of course. Most of you have probably worked and received payment. Payroll can be kind of broken down into 2 categories. There are salaries, which are a fixed monthly amount paid to workers, or there are wages, which is hourly pay for workers. In the state of Washington, we use the term exempt and non-exempt. And it has to do with the Fair Labor Standard Act. So that's a federal law that says any employee that works over 40 hours, so physically working over 40 hours in a work week, that they be paid 1.5 times their regular rate of pay for any hours over the 40. Now, as an example, if Monday is a holiday and then you work 10 hours each day, Tuesday through Friday, you haven't earned overtime because you haven't worked more than 40 hours in that week. Now, again, companies can do more than that, but they have to at least do that. So in the state of Washington, we consider a worker to be exempt from being paid overtime if they're in management, if they're a professional, so they have some license or designation, if they're engaged in creative practices, or if they're paid above a certain minimum salary. So $67,725 now. Anybody else, so if you get paid less than that on an annual basis, then you are required to get overtime. There are very severe penalties for companies that abuse that law, for companies that work their workers more than 40 hours but don't pay them that overtime. There are substantial painful penalties to that. So total earnings equal gross pay. Those are the same terms. So if you get paid $20 an hour and you work 40 hours, then your gross pay is $800. That's not the amount you're going to see on your paycheck because there's going to be deductions. So the deductions are taken away. That's your net pay. So some common deductions would be federal income tax withholding. So that's money the company takes out of your check and sends to the IRS with your Social Security number on it. Another one is FICA, which stands for Federal Insurance Contributions Act. That consists of Social Security, which is 6.2% of the gross pay, or up to pay of $168,600. Once you reach that level on a year-to-date basis, you're no longer subject to that withholding tax. And then Medicare is 1.45% of gross pay, and there is no salary limit on that. You pay it entirely. There may also be some other deductions from your paycheck. You may pay a portion of your medical benefits. You may contribute to a retirement plan. You may have union dues or charitable contributions that you make to United Way, as an example. Those would all be other deductions from your paycheck. Now, the way the entry is made is we debit the expense for the gross wages. So we calculate, and usually are multiple different categories that employees fall in based on their department or their job category, that sort of thing. So we debit that for their gross wages, and then we credit for all of the deductions we made from their paycheck by crediting a payable account, a liability. So you can see Social Security, Medicare, so forth, all of those. And then the net amount is salaries payable. So that's the amount we'll pay on payday. That's the net amount of people's paychecks. So on payday, we'll debit that salaries payable and credit cash, just like we pay any other payable. There's an additional entry that needs to be made, which is recording the payroll tax expense that the company incurs. So the company pays payroll taxes in addition to the payroll taxes that are deducted from somebody's paycheck. So the ones that are paid by the company, they have to match the Social Security amount. So if they take out 6.2% of your pay and send it to the federal government, the employer adds another 6.2% to that with your Social Security number attached to it. They have to match Medicare. And then the employer has to pay state and federal unemployment taxes. The employee doesn't pay that. So those are liabilities that are created with each pay period, and we record payroll tax expense for that. So the next subject is notes payable, and interest accrues as time goes by. So for a short-term note payable where we pay the interest when the note matures, we have to be a little bit careful when the note goes over a year-end period. So in this case, we borrow money on November 1st of year one. We borrow $100,000. So we're going to debit cash and credit notes payable. And then on December 31st, I'm going to stop and say, okay, I have owed this money for a period of time, so I also owe some interest. So I'm going to have to make a journal entry where I accrue that interest and increase my liability. So I'm going to debit interest expense and I'm going to credit interest payable. And the formula for calculating the amount of interest is the principal amount borrowed times the interest rate in decimal form times the period of time in which the loan has been outstanding. This is 2 out of 12 months. 12 will always be the denominator because the interest rate is an annual interest rate. So it'll always be the fraction of the year we're talking about. And then the following year, you see here it's due on April 30th. So then we'll accrue the remaining interest payable. So 100,000 times 12% times 4 over 12. And we'll make the same similar kind of entry. Then when we pay the loan, we're going to be paying the interest payable, paying the note payable, so we'll debit both of those accounts to wipe them out, and we'll credit cash for the total amount. This gets the interest expense in the correct period and avoids making one year look better and the other year look worse. So contingent liabilities are a little bit tricky. They definitely involve estimation, and these are liabilities that are based on something that has happened during the accounting period that we believe is going to result in some kind of payment due down the road. A really common example is a warranty on a product. If I'm selling lawnmowers and there's a 3-year warranty on the lawnmower, I know that some of the lawnmowers I sell are going to need repairs or replacements under that warranty. And of course, that expense is associated with the sale I made this year, even though I might not get a claim on that warranty for 2 or 3 years. So the way we judge those kinds of potential liabilities is we look at the likelihood that we're going to have to pay something in the future, and we categorize it either as probable, reasonably possible, or remote. So probable is it's probably for sure going to happen. Reasonably possible is it's a 50-50 chance, and remote is it's probably not going to happen. And then the second factor is, can we estimate it in a reasonable way, or is it impossible to estimate it? Based on those two criteria, that will lead us to do something. So if it is probable that we're going to have to pay money, and we can estimate it, then we're going to record and disclose the liability. So we're going to record an expense like warranty expense and warranty payable, or lawsuit expense and lawsuit payable, whatever the case is, we're going to make that entry in the period. If it's probable but we can't estimate it, we're going to disclose that in the notes to our financial statements. We're going to let people know, hey, this happened. We're probably going to have to pay money about this, but we really don't know what the outcome is going to be at this point. If it's reasonably possible, then we disclose it in the same way. If it's remote, we don't do anything. We don't have to make an entry and we don't have to disclose it. So a little bit about time value of money. I just want to raise this topic with you so that you're familiar with it when you take 301, because you'll spend more time on this subject in 301. So the key thing about the time value of money is $1 today is worth more than $1 tomorrow, because you could invest the dollar today and have your dollar plus the interest tomorrow. So any money that is going to be, that we're going to have to pay in the future or is going to be paid to us in the future, when we're reporting that today, we need to do it in current dollars. So if I have two liabilities that are both $1,000 and one is due this year and one of them is due 5 years from now, I wouldn't record $2,000 of liabilities. I'd record $1,000 plus the present day value of that future $1,000. So present value calculations are usually done with a figure on a chart. That's what most students do. There's really 3 different ways of calculating present or future value if you do the opposite of it. Most people use Excel for the calculation. Many people use tables, which I'll show you in a couple of slides, or some people use a formula. So there's a couple of ways to do it. The formula is as follows. So the future value of a single cash flow, I put money in the bank today and it's going to have compounding interest every year. It's going to add interest and then I'll get interest on the interest, that kind of a thing. The future value is what I put in today times 1 plus the rate to the nth power, n being the periods. So if I wanted to know if I put $1,000 in the bank and the interest rate's 5%, what am I going to have in 5 years? I would use that formula to get that amount. If I'm doing the opposite, if I'm saying I'm going to get $1,000 in 5 years, what's that worth today? I would take that future value, the $1,000 I'm going to get in 5 years, I would divide it by 1 plus r to the nth, and that would get me some figure in the high 4,000s probably that it's worth today. So here's an example of a table where you could look up those rates. So example, this is a future value table. So if I'm putting $1,000 in and it's at 5% for 5 years, I could multiply, I could go down the 5% column, come over on the 5-year row, and I would see 1.276. I could multiply 1.276 times $1,000. That tells me that if I put $1,000 in the bank at 5% compounding interest, I'll have $1,276 in 5 years. So that's how to use that table. There's a corresponding table that you would use the same way for present value. I'll make sure I put those on Moodle for you. So here's an example of a future value problem. So they want to determine the future value of $50,000 invested for 5 years, compounded annually at an interest rate of 6%. So we do the math there, or we could either do the math or find that figure on the table, and we could determine that amount. So this comes in important when we're analyzing things, when we have multiple different options to either pay money over time versus paying immediately, or we're going to receive money over time versus receiving it immediately. A real common example that you can probably all relate to is you win the lottery. And you can take that in one lump sum, or you can take it in equal payments over 20 years. So you would use present value to determine which is the better deal, as an example. So one of the things important is making sure when we make comparisons of different things that we bring all of the money to today's value. So we're comparing today's dollars to today's dollars to make a decision about different alternatives. So here's an example of a present value calculation. So the company is going to receive $73,466 in 5 years. What is that in today's dollars? In this case, it's $50,000 in today's dollars at that 8% interest rate. So there's also annuities. So the difference between a lump sum, which is one amount at the end of a period of time, and annuity can be used. It's a kind of a shortcut when you have annual payments or annual receipts of the same exact amount in each period. So you can take a bit of a shortcut and use the table that shows ordinary annuities to bring all of that stream of cash back to today's value. So here's an example of doing that manually. So this company is going to invest $10,000 today in a machine that saves us $2,000 in labor every year for the first 3 years, $1,500 for the next 3 years. Is that a good deal or not? In this case, it's not a good deal. We shouldn't do it. It has negative present value. So the money we're putting out in today's dollars is more than the amount we're going to save in today's dollars. And I needed to do the present value calculations here so that I could be adding up everything in today's dollars versus adding year $3 to year $0 as an example. So this is the term is net present value. It's when we have money coming in and out when we want to see what is the net impact of that. So that is the end of chapter 9. Please take the time to look through or to work through the in-class practice problems and look at your solutions and then complete your homework. And then the next step will be to take the next exam. So I look forward to speaking to you again when I lecture on chapter 10. Thank you.